Understood. Looks like we have an Airbnb question.
Uh-huh.
Someone wants to know if someone rents out their home on Airbnb, what's the best way to keep personal and rental expenses separate from each other?
It depends, right?
It depends.
I've seen it, and it really depends on what exactly you're doing. So I've seen people who, like in the early days of Airbnb, they would just rent out a room, right? And people still do this, but it's not as popular as it used to be. So they've got 4 bedrooms, they're not using one. One bedroom is available as a rental, and people come in and come and go out throughout over time. I had one client tell me that that's what they were doing. That was pretty much all their income actually, and she was saying that they had crazy stories from people doing that because you're sharing your home with these random strangers, effectively. So that's one scenario where you're just renting out a room or a floor or whatever, and you're still there. The other scenario is that you are leaving for a time, and while you're gone, you rent out the place, right? So either way, what you have to do is you have to separate out the expenses. The revenue part is no problem. So whatever came in through Airbnb, that's your revenue. But the expense part is going to be apportioned. And if they're going to be sharing the space, then it's going to be a percentage apportionment based on space. If you're leaving for a couple of weeks and renting out the whole place, then it's going to be apportioned based on time. If I leave for 2 weeks out of February, that's 1/2 of the month. So I could take my monthly expenses and divide by half, and I can get a number that way. Another question comes in is, do you want to depreciate? Because as an investment property, you are entitled to depreciation. But as a practical matter, you may not want to. And you'll hear people talk about allowed or allowable. That's not actually a problem anymore. That was fixed several years ago. But if you depreciate the business use of your property and then you go to sell, normally when you sell, you get a personal use exclusion of either $250,000 if you're single or $500,000 if you're married filing joint. But if you have business use in the history of that, you have to recapture that business use, and that does not apply to the personal use exclusion. And so then you're going to have a 25% recapture tax on that business use deduction that you got however many years ago. Depending on the numbers, and depending on what your future plans are, you may not want to depreciate, and you may want to just pick up the extra tax on that so that you don't have to pay a recapture tax when you sell. Again, depends. How does that 25% recapture rate compare to your regular rates? And most people, I would say the average federal tax rate that people pay is either going to be 22% or 24%. Usually 25% is going to be higher. That's something to consider. But if you're going to sell 10 years from now, well, take the deduction now. And then time value of money is going to be better off in your pocket rather than waiting 10 years. If you're going to sell next year, maybe you don't want to depreciate. So that's the consideration to put in there. But yeah, so you got to, whatever method that you use, you got to figure out what expenses are, the word is allocable, which expenses are allocated to that rental use and which are personal use, and you got to separate them out that way. So that's the basic idea. How you do that depends on what you're doing, what expenses you have, and all that kind of stuff.
So another it depends question.
Yes, every question is it depends.
Right, understood. It looks like we have a crypto question.